Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies and study how they actually think. Today we're looking at an expert advisor for MetaTrader 5 called Half Life Reversion Fade. It's a mean reversion system with a twist. Before it fades any stretched price, it measures how quickly the market is really pulling back toward its average, using a statistical model called an Ornstein-Uhlenbeck process. By the end of this video, you'll understand its entry logic, its exits, and the code behind it. Remember, this is educational information only. Let's dive in. So what exactly is Half Life Reversion Fade, and who might study it? At its core, this is a mean reversion strategy, a so-called fader. Instead of chasing momentum, it does the opposite. It looks for moments when price has stretched unusually far from its recent average, and it positions for a move back toward that average. But here's what makes it different from a plain Z-score or Bollinger Band fader. It refuses to fade blindly. Before every trade, the strategy runs a quick statistical experiment on recent prices. It fits what's known as an Ornstein-Uhlenbeck process, or in discrete terms an AR1 model, to the last several dozen closes. This model estimates how strongly and how quickly price is being pulled back toward its mean. From it, the strategy derives a reversion half-life, the number of bars it usually takes for an extreme to fade halfway back. That half-life becomes a gate. If the market is reverting quickly and reliably, the strategy engages. If the market is trending or behaving like a random walk, where extremes just keep extending, it steps aside entirely. This EA is built for a single time frame, and it reads everything from whatever chart period you attach it to, so you can study it on anything from a 15-minute chart to a daily. It uses two well-known tools, a Z-score to measure the stretch, and the average true range, or ATR, to size its protective stop. The take profit is always the window mean. In terms of temperament, this is a strategy suited to traders who are curious about market regimes and statistical filtering, rather than those looking for constant action. It trades selectively, only when its reversion gate approves. As always, remember that trading carries risk and losses do happen, and everything here is for education, not financial advice. Let's walk through the mechanics step by step. Half-Life Reversion Fade works only on closed bars, so it makes one decision per completed candle rather than reacting to every tick. On each new bar, it takes the most recent closes, 40 of them by default, set by the RegPeriod parameter, and treats that as its working window. The first thing it does is fit a statistical model to those closes. It regresses each one-bar price change against the price level that preceded it. In plain English, it's asking a question. When price is high, does the next move tend to pull it back down? And when price is low, does the next move tend to lift it back up? That relationship is captured by a single number called beta. If beta is positive or zero, the market is trending or wandering like a random walk, and the strategy simply stands aside. There's nothing reliable to fade. If beta is negative, price is being pulled back toward its average, and the strategy converts that into a reversion half-life, the number of bars it typically takes for a stretch to decay halfway back to the mean. This is the heart of the system. Only if that half-life is short enough, 20 bars or fewer by default, set by MaxHalfLife, does the strategy consider the market fast and reliable enough to trade. A slow, sluggish half-life is rejected. Once that regime gate passes, the strategy measures the stretch. It calculates the window mean and standard deviation, then computes a Z-score, how many standard deviations the latest close sits from the mean. This is the fade condition. If the Z-score is at or below -2, price is stretched well below its average, and the EA signals a buy. If the Z-score is at or above +2, price is stretched well above its average, and the EA signals a sell. That threshold is the EntryZ parameter. Exits are symmetrical and clean. For both directions, the take profit is the window mean itself. The strategy is simply anticipating that price returns to normal. The stop loss is set an ATR multiple beyond the entry, using a 14-period ATR and a multiplier of 2 by default. If price keeps running against the trade instead of reverting, that's a sign the fade has failed, and the ATR stop limits the loss quickly. The strategy also holds only one position at a time per symbol, so it never stacks multiple fades on top of each other. Let's read through the actual MetaTrader code. At the top are the input parameters you can adjust in the strategy tester. RegPeriod, defaulting to 40, is the regression window, how many closes the model studies. EntryZ, defaulting to 2, is the z-score stretch required to fade. MaxHalfLife, defaulting to 20, is the slowest reversion half-life the strategy will accept. ATR period and ATR stop multiple, 14 and 2, define the stop distance. Lots sets the order size, and magic tags the trades so the EA can recognize its own positions. Below the inputs is the core calculation. The variable z is the z-score, the close minus the window mean, divided by the standard deviation. From that, two conditions are built. The long signal is true when z is at or below negative EntryZ, meaning price is stretched below the mean. The short signal is true when z is at or above positive EntryZ, meaning price is stretched above the mean. Now look at the buy block. When the long signal is true, the entry is taken at the ask price. The stop loss is placed the ATR multiple below the entry, and the take profit is set to the mean, the level price stretched away from. There's a small safeguard. If the mean happens to sit at or below the entry, the take profit is nudged to a sensible ATR distance above instead. Then trade.by sends the order. The sell block is the mirror image. When the short signal is true, the entry is taken at the bid, the stop loss sits the ATR multiple above the entry, and the take profit is again the mean. Trade.sell sends that order. Both sides share the same simple idea. Fade the stretch, target the average. Let's bring the whole idea to life on a chart. What you're watching is a Euros-style price series up top, and beneath it, the strategy zone gauge, a z-score that measures how many standard deviations the latest close sits away from its rolling window mean. The dashed line at +2 and the dashed line at -2 are the fade thresholds, set by the EntryZ parameter, and the center line at 0 is the mean the strategy is always measuring against. Keep in mind, none of this fires unless the reversion regime gate has already passed. The Ornstein-Uhlenbeck fit must show a fast enough half-life, under the 20-bar limit here. Watch the opening candles. Price is hovering close to its average, and the z-score sits near 0. Nothing stretched, nothing to do. Then the market starts sliding lower. The second and third candles print fresh lows, and as they do, the z-score dives down through the -2 line into the lower zone. This is the strategy's cue that price has stretched well below its mean. Because the reversion gate has confirmed the market is genuinely pulling back rather than trending away, the EA acts on that stretch. You can see the buy entry marker appear right at that stretched low. The logic here is simple. The further price has been pushed below its average in a proven mean reverting regime, the more room there may be for it to move back. Now follow what happens next. The fourth and fifth candles begin climbing. Price is reverting, exactly as the model expected, and the z-score climbs back up out of the lower zone toward the center. The take profit for this long is the window mean itself, not some arbitrary distance, but the very average the price stretched away from. As price returns to that average, you see the take profit marker complete the trade. Notice we never needed price to reverse into a whole new trend. We only needed it to travel from an extreme back to normal. And had price kept falling instead, the stop loss, placed an ATR multiple below the entry, would have capped the loss quickly, because a break that keeps extending is exactly the failure mode this system wants to exit fast. With that long closed, watch the second half of the chart. Price keeps pushing higher through the 6th, 7th, and 8th candles. Now the stretch is building in the opposite direction. The z-score rises up through the +2 line into the upper zone, telling the strategy that price now sits far above its mean. Again, assuming the reversion gate confirms a short half-life, the mirror image condition is met, and the sell entry marker appears at that stretched high. The strategy is fading the move, selling into an overstretched rally, expecting the elastic to pull price back down toward the average. And that's what the final candles show. The 9th, 10th, and 11th candles roll over and drift lower. The z-score falls back out of the upper zone toward 0, and price glides down to its mean, where the take profit marker closes the short. Same structure as the long, just flipped. Fade the extreme, target the mean, and keep an ATR-based stop beyond the high in case the rally turns into a real breakout instead. Step back and look at the rhythm. The oscillator swings from one extreme to the other, and the strategy only engages when the swing reaches those 2 sigma thresholds and the Half-Life gate says the reversion is fast enough to trust. The take profit is always the mean, which sits right in the middle at 0 on the panel. That's the entire personality of Half-Life Reversion Fade. Patient at the center, active at the edges, and always asking whether the market is really the kind that comes back before it commits. And that brings us to the end of our breakdown of Half-Life Reversion Fade. We covered how it fits an Ornstein-Uhlenbeck model to recent closes, how it measures the reversion half-life to decide whether the market is worth fading, how it uses a Z-score to spot stretch prices, and how it targets the mean with an ATR-based stop protecting each trade. We also walked through the MetaTrader code and a candle-by-candle example of both a long and a short. If you found this useful, please give the video a like, subscribe for more MT5 strategy analyses, and drop your questions in the comments. You can find more educational breakdowns over at www.algobot.live. Everything here is educational information only, not financial advice, and not a recommendation to trade. Past performance does not guarantee future results. Trade responsibly.